What if the biggest mistake you could make right now is assuming silver will wake up later, like it always does? Silver has just pushed out of that long, sleepy, it'll move later box, and the silver gold relationship is flashing the same kind of pressure signal that has shown up before past blow off moves. The setup is tightening right now, and if the bond market twitches the wrong way, the next leg can begin within hours. The window is open, and it's narrowing fast. Quick ask, if you want updates like this before the move goes mainstream, subscribe and turn on notifications. That way, when the window tightens, you're not finding out after the price has already sprinted. Most people are staring at the price of silver like it's the whole story. It isn't. The real story is the spread. How inexpensive silver still is compared to gold, and how sharply that spread has snapped back in earlier bull runs. If you miss that, you'll do what crowds always do. Wait for confirmation, then buy the top. Or you'll do something worse. You'll sell early because a chart indicator screams overbought while the move is only beginning. So let's make this easy to follow. For decades, silver has spent most of its life inside a familiar relationship to gold. In plain terms, gold is the big metal and silver trades as a smaller fraction of it. In quiet, boring years, silver hangs around that normal band. It drifts, it wiggles, it behaves like a polite commodity. But in real bull phases, true bull phases, that band doesn't stay neat. It stretches, the ceiling lifts, and silver stops behaving like a calm market and starts acting like something that's been pushed underwater for too long, and finally gets air. That's when the move doesn't feel gradual. It feels sudden. Now here's the part that should make your ears perk up. Even after the recent action, silver is still not expensive relative to gold. It's still cheap. Historically cheap. Not kind of cheap, not maybe cheap. Historically discounted. And that's exactly why the next move can be brutal, in a good way. Because it's not beginning from an overheated relationship. It's beginning from an undervalued relationship that hasn't been fully corrected. And before you think this is just another manipulation speech, let me be direct. Yes, markets have a long record of bad behavior. We've seen investigations, penalties, and public cases. That's all real history. But whether you believe in suppression or you reject it completely, it doesn't change the math that matters right now. Sustained demand meeting constrained supply creates pressure. Pressure stacks up. And when markets ignore pressure for too long, the release doesn't arrive gently. It arrives fast. It arrives loud. It arrives at the worst possible moment, when late buyers demand certainty, hesitate, and realize the price already ran away. Here's what's different today. Silver isn't just a shiny metal people grab when they're nervous. Silver is embedded in the physical infrastructure of the future. Power systems, electronics, high-density computing, grid upgrades, energy storage, and the industrial plumbing that modern life keeps adding. It's not optional. You can't simply swap it out easily and keep performance the same. That means demand doesn't need a loud bullish mood to be real. Demand can show up quietly, steadily, and mechanically, because industry requires it whether you feel excited about it or not. Meanwhile, supply doesn't magically surge just because prices finally wake up. Mines take time. Projects take time. Investment takes time. And years of dull pricing create consequences. Less exploration, less expansion, less spare capacity. So when the world suddenly remembers it needs more silver than it can comfortably produce, the market doesn't respond with a calm adjustment, it responds with a repricing event. Now stay with me, because this is where things get spicy. In prior bull runs, the silver to gold ratio didn't just drift higher, it expanded. It doubled from depressed levels. In one major surge, it exploded to levels that would sound ridiculous to anyone anchored to the normal regime, and that's the trap. People stay anchored to normal because normal feels safe, normal feels reasonable, normal feels predictable, but bull markets don't care what feels safe. So ask yourself this: if gold keeps trending higher and silver simply returns to its normal relationship, that alone implies a powerful move. But what if silver doesn't stop at normal? What if it does what it has done before during true bull phases and pushes well beyond? That's where the headlines come from. That's where the parabolic candles come from. That's where people wake up and say, how did it move that much that fast? And the answer is almost always the same, because it was underpriced for too long. Now I want to talk about the psychological mistake that ruins most people's position. It's the overbought panic. It's the moment silver surges. Your screen flashes a momentum indicator above some textbook threshold, and you persuade yourself the move must be finished. In normal markets, that logic can protect you. In monster markets, that logic can destroy you. In historic surges, momentum stayed overbought for months, not days, months. If you sold the first time your indicator told you to, you didn't lock in smart profits. You volunteered to miss the entire run. And then you watched from the sidelines while your brain tried to justify why you were right even though your portfolio was wrong. So what do you do instead? You stop treating this like a normal trade, and you start treating it like a regime change. That does not mean you buy blindly. It does not mean you use reckless leverage. It means you stop using weak signals as an excuse to abandon the strongest setup. And if you're wondering what a real surge would look like, imagine this. Gold continues its climb, not necessarily in a straight line, but in a steady march higher. Silver, still discounted, begins to catch up. At first it looks ordinary, a pop, a pullback, a grind. Then it hits the zone where old ceilings used to live, historic highs that people treat like impenetrable walls, and then instead of rejecting, it breaks through. That's when the narrative changes. That's when the speed changes, because once a market exits an old range, it doesn't just politely return to the middle. It often does what it should have done years earlier, but compressed into a much shorter period of time. That isn't irrational. It's overdue. Now here's the cliffhanger. The metal market is not the only thing under tension. The bigger threat and the bigger fuel is sitting in the bond market. This is the part almost nobody wants to discuss because it's boring until it isn't. Government debt has become the core of the global asset world. It's the foundation under pensions, banks, insurance portfolios, and safe savings products. So ask yourself this. If gold keeps trending higher and silver simply returns to its normal relationship, that alone implies a powerful move. But what if silver doesn't stop at normal? What if it does what it has done before during true bull phases and pushes well beyond? That's where the headlines come from. That's where the parabolic candles come from. That's where people wake up and say, how did it move that much that fast? And the answer is almost always the same, because it was underpriced for too long. Now I want to talk about the psychological mistake that ruins most people's position. It's the overbought panic. It's the moment silver surges. Your screen flashes a momentum indicator above some textbook threshold, and you persuade yourself the move must be finished. In normal markets, that logic can protect you. In monster markets, that logic can destroy you. In historic surges, momentum stayed overbought for months, not days, months. And when that foundation starts wobbling, the response is never elegant. It's emergency measures, it's liquidity programs, it's bigger balance sheets, it's authorities stepping in to stop yields from spiking and prices from breaking. But here's the problem. If policymakers have to keep stepping in, what does that say about the money unit itself? If the system needs constant intervention, then holding paper promises becomes a risk, and holding real assets becomes a strategy. And gold and silver are the purest expression of that shift. You don't have to predict the exact day a bond market event hits. You just have to recognize the risk is rising, the interventions are getting louder, and the consequences of printing to patch are always the same. It debases purchasing power. Real assets reprice upward. Metals don't need permission, they just respond. Now, quick pause, because I know some of you are building positions right now. If you're stacking physical, make sure you're not overpaying on premiums. Check the link in the description for a reliable place to compare current deals. And if you're new, look for first-time buyer specials. Keep it simple. Good pricing, trusted delivery, and don't get cute with gimmicks. All right, back to the real story. Let's also clear up a myth that keeps scaring people out of the best moves. If the stock market falls, metals must fall too. That's not a rule. Sometimes during a sudden crash, everything gets sold at once because margin calls force liquidation. That can drag metals briefly, but historically when the dust settles, gold often recovers faster and sometimes rises while stocks are still bleeding. The correlation is not a law, it's a headline. Now, I'm not saying the stock market collapses tomorrow. Markets can float higher for months while internal stress builds. They can grind upward, tease new highs, and make everyone complacent. And then, when underlying supports crack, you don't get a polite warning. You get a gap, you get a cascade, you get a scramble, and that scramble is fuel for real assets. Now back to silver, because this is where the opportunity and danger meet. If silver runs hard, it will also pull back hard at times. That's normal. A move can be bullish and violent in both directions. The mistake is confusing volatility with failure. Picture silver sprinting toward a new regime, then snapping back. People will scream collapse. They'll declare the move dead. But if the market is shifting to higher levels, those pullbacks are often resets, not reversals. They flush weak hands, wreck leveraged gamblers, and hand the next leg to stronger buyers. And this is where discipline matters. If your plan is buy, panic, sell, then rebuy higher, you're donating money to the market. If your plan is position with intent, manage risk, hold through noise, you're giving yourself a chance to ride the revaluation. Now let's talk about time, because everyone wants a date. They want the exact hour, they want certainty. Markets don't give certainty, but they do give windows. And the window now is defined by two forces colliding: silver's undervaluation versus gold and increasing fragility in the debt system. When those two align, moves can begin abruptly. Not because someone announced it, but because the last seller dries up and the next buyer is forced to pay up. That's how gaps form. That's how you wake up, and the price is already higher than you thought possible the night before. So here are the scenarios you need to think about. Scenario 1, gold keeps trending higher, and silver merely returns to its longer-term average relationship. That alone is a major move from current levels. Scenario 2, silver does what it's done in past bull phases and overshoots its average relationship, chasing higher percentages that sound extreme until you remember history has already printed them. Scenario 3, the bond market stumbles, policymakers respond aggressively, and metals react, not gradually, but violently, because confidence gets repriced overnight. Now, which scenario is guaranteed? None. But which scenario is plausible? All three. And in a world where plausibility is enough to move capital, you don't need a guarantee for the market to reprice. This is why the old reality for silver doesn't come back easily once a real bull regime takes hold. The old reality was built in a different world. Different demand structure, different technology footprint, different macro stress, different financial plumbing. If you're still expecting the market to behave like that world, you're using the wrong map. Now I want to drop in something important, and I'll say it plainly. If you're not positioned for the next several months, you might miss the most explosive part. The early phase feels uncomfortable because it still feels too late, even though it isn't. The middle phase feels euphoric. The late phase feels like a dream, until it doesn't. The key is catching the transition from early to middle when it stops being a debate and begins to feel like a stampede. And you can spot that transition by watching the relationship to gold and the behavior of pullbacks. In a weak market, rallies fail and pullbacks break down. In a strong market, pullbacks get bought and highs are challenged again quickly. Strength is not perfection. Strength is refusal to die. Now, before I go further, I'm going to do something a little different. If you want to hear silver-related success stories, regular people who made smart moves, avoided traps, and built wealth, there's a link in the description to another channel focused on those case studies. Go subscribe over there as well, because sometimes the best lesson isn't theory. It's seeing how others executed when it counted. All right, back to the cliffhanger we parked earlier. Bonds. If long-dated government bonds start slipping and yields stop cooperating, the reaction function becomes aggressive. You see more buying, more programs, more temporary measures that become permanent. And every time that happens, the market learns a lesson. The system will protect debt prices with currency creation. That is rocket fuel for gold. And when gold moves, silver, still discounted, tends to move harder. Now let's address the part that scares people. What if silver spikes and then crashes? Yes, it can. It can surge to a level that shocks everyone and then retrace a chunk. But ask the deeper question, does it return all the way to the old range, or does it establish a higher floor? In prior regime changes after the mania, the new boring level was still dramatically above the old one. That matters, because if the floor moves up, every future cycle begins from a higher base. And that's how markets stepladder wealth over time. Now, I'm going to challenge you with a thought experiment. Imagine silver runs to a number that sounds crazy today, then pulls back sharply. Would you feel smart for being out? Or would you feel sick because you sold a long-term shift for a short-term dip? Most people answer that emotionally after the fact. The winners answer it before, with a plan. So here's the plan logic I like. Separate your position into core and tactical. Core is what you don't touch unless the thesis breaks. Tactical is what you manage around volatility. That way you're not forced to choose between being all in and being all out. You can ride the monster while still respecting risk. Now here's another cliffhanger. The biggest mistake might not be selling too early. The biggest mistake might be not being there at all when the move starts. Because in these markets, the first burst can cover months of normal movement in a handful of sessions. If you're waiting for a dip that never comes, your discipline becomes regret. And yes, the next candle can start before your morning coffee finishes. So I'll ask you two questions, and I want your honest answer in the comments. First, do you think silver is still undervalued compared to gold, or do you think the market has already priced it in? Second, if silver spikes hard and then pulls back, are you the type to panic out or the type to add on weakness? Drop your answers below. I read them, and it helps me tailor the next video. Now let's wrap this into a clean takeaway. We're looking at a market where silver is still cheap relative to gold, demand is not fading, supply can't respond instantly, and the broader financial system is leaning harder on intervention to keep debt markets from cracking. That combination doesn't promise a straight line up, it promises volatility with an upward bias and the kind of sudden repricing that makes headlines after the move is already underway. So what happens next? One of two things. Either silver grinds higher, frustrating everyone who wants fireworks, until the spread quietly improves, and the market resets without drama. Or the pressure releases in a sharp run that forces revaluation fast. And if it's the second, it won't give you comfort, it'll give you speed. If you want more breakdowns like this, short, direct, and focused on what actually matters, subscribe and keep notifications on. When a move can begin within hours, the worst time to learn is after it already happened. Let me know in the comments below. If silver launches and pullbacks get violent, will you treat that volatility as failure or as the market proving it's entering a new regime?